Hi, this is Lori Hiscock at Ruoff Home Mortgage. When I'm talking to first-time home buyers, they often ask me about the first-time home buyer programs. They specifically want to know about government-supported programs that might offer them some advantages. While there are not nearly as many of those as people think there are a couple that are very, very good, and my favorite is the Mortgage Credit Certificate program offered by the state of Indiana. Let me talk to you a bit about that here. It is called the MCC, stands for Mortgage Credit Certificate. It is provided by Indiana Housing Community Development Authority, which we call IHCDA. I'm just going to call it the state of Indiana. And what it is an option for a first-time buyer to get an income tax credit based on the interest they pay on their mortgage. So let's talk about the details of that a bit. First, let's describe a first-time home buyer. For the state of Indiana, they mean anybody who hasn't owned a home in the last 3 years. So if you owned a home 5 or 6 years ago, you would still be considered a first-time home buyer if it's been at least 3 years since the last time you owned it. If you are buying in certain areas that are considered exempt, targeted areas, you don't have to be a first-time home buyer. Those are a very limited area, but I'm more than happy to share a list of those with you. In addition to being a first-time home buyer, there are also income limits. If you make too much money, you won't be eligible for this program, even if it's the first time you've purchased a home. The limits change every year, and they are based on the county you're buying in and on the number of people in your household. So to find out what the limit is, you just need to speak with me and we can look at the chart for the current year. Additionally, there is a limit to how expensive the home can be. I will say this is very rarely a problem. The limit is quite high, but we'd want to check that as well and make sure that you're not buying beyond the price range of what's allowed for this program. But let's say you are a first-time buyer, your income is within the right range, and you are buying a home under the maximum price, then you would be eligible for the Mortgage Credit Certificate. So let's talk about what it is. It is an option that allows the home buyer to claim a tax credit for a portion of the mortgage interest paid each year. It is a dollar-for-dollar reduction against your federal tax liability. So let's be clear on this. This is a credit, not a deduction. A tax deduction reduces the amount that you're taxed on. A tax credit is actually a dollar-for-dollar increase in your refund each year. So it's direct money in your pocket. It's a wonderful program. Now, the amount of this credit is based on your mortgage. The smaller your mortgage amount, the higher percentage of the interest you get back. That's to help make it fair to people regardless of what price they're buying. The range is between 20% of the interest you pay to 35%. So if you're buying a less expensive home, you can claim more of the interest as that credit. If you're buying a more expensive home, you claim less. There is a maximum amount that you are allowed to get. That maximum is $2,000 a year, and it needs to be noted that you have to at least pay taxes to be able to get this credit back. For example, it rarely happens, but every now and then I get a first-time home buyer who doesn't have any taxes. It may be because their income is from Social Security and they don't make enough to have to pay taxes. Or it could be that they are a veteran and it's purely VA benefits that are non-taxed. If you don't have any taxes withheld from your paycheck, you don't have any tax liability, you're not going to get the money back. But if you're like most of us, you're paying taxes and then you can get that credit up to $2,000. Now, every year the amount that you're going to get is going to decrease a little bit because it is a percentage of the interest you're paying, and every year you're paying a little less interest. We're not talking a big decrease though. It typically tends to be $10 to $20 a year, maybe a little more, but you're still getting a significant credit year in and year out as you pay off this loan. Here's a little chart that gives some more information on the percentage of tax credit that you get. As you can see, it is a percentage based on your mortgage amount. Again, trying to make it fair so that the person buying the $40,000 home is going to get a similar benefit to the person buying the $100,000 home. Now let's see how the borrower can use this tax credit to benefit them. You really have two ways. First, you can just wait till the end of the year and get a bigger tax refund. Here is an example of how that would work. Let's say, for example, you were buying a $110,000 home and the interest rate at the time was 5 1/4. At $110,000, you get 20% of the interest back. So in that first year, you would get $1,155 as an increased tax refund at the end of the year. You can just wait until the end of that year, file your return, and get that refund then. Another option is to get it every month. You would do this by talking to your employer and revising your W-4 withholdings so that they're not taking as much out of each paycheck. Yes, they're taking less out, so your tax liability due will be more at the end of the year, but your credit will be there at the end of the year to offset that. So by doing this, you can get more each month instead of getting it all back at one time. In the same example, if you had them change it so that you got $96 more every month, that would cover that credit at the end of the year and make it a wash then, but put the money in your pocket monthly to help cover your mortgage payment. So why wouldn't a home buyer do the mortgage credit certificate program? Well, there's typically two reasons. The first is they don't know about it. A lot of lenders either don't participate with the program, or if they do, they don't even really know how to do it, so they don't make their buyers aware of it. So if that's your scenario, your lender hasn't mentioned it, or they're not able to, that would be a problem. You would want to connect with a lender like us who does this program. A second reason people sometimes don't do it is because there is an enrollment fee. It is not a free program up front. It's worth the cost, but it's not free. The state charges 0.5% of the loan amount as an upfront fee. So let's say you were buying a $100,000 home, or that was your mortgage amount. You would have to pay $500 to enroll. Now, that being said, you are going to get more than that back in your first year by the credit. And every year you're in the home, you live in it, you continue to get that credit. So it more than pays for itself within that first year. But nevertheless, you need to enroll and pay that fee right up front when all the other money is also going out. When you buy a home, you're paying earnest money, you're paying for the appraisal, you're paying for inspections, and now here's another check you need to write. Well, yeah, it is a cost, and it is tough timing on that, but if you can budget it into your budget, it is so well worth it. You earn the money back quickly, and you get that credit as long as you own the home and live in it. So all in all, the Mortgage Credit Certificate Program is a great program for the first-time buyer, and if you're eligible, you should strongly consider it. If you have questions on this program or on any other aspect of home financing, I'm always happy to help. Feel free to give me a call or pop me an email. Thanks and have a great day.